As of this exact moment, Broadcom Inc., AVGO, is trading at $375.40 USD, surging by plus 20.98 points or a massive 5.92% on the day. We are witnessing a significant breakout in real time, with the stock pushing aggressively against its upper resistance levels, fueled by a sector-wide rally that seems to be repricing the entire semiconductor infrastructure landscape. If you are watching the charts right now, you are seeing a classic gap-and-go formation, where the opening strength wasn't sold off, but rather bought up by institutional volume, suggesting this move has genuine legs. Now, here is the tension, the gap between what most retail investors expect and what the smart money is actually doing. The general expectation with Broadcom is that it is a boring dividend growth stock, or perhaps just a secondary play to Nvidia stock. Investors often view it as the legacy player, reliable, steady, but perhaps lacking the explosive hyper-growth potential of a pure-play AI darling. They see the massive debt load from the VMware acquisition and assume the company is in a digest and rest phase, moving slowly while the rest of the tech sector sprints. That is the expectation, a safe defensive chip stock. The reality? The reality is drastically different and far more aggressive. What we are seeing today isn't just a sympathy rally, it is a market realization that Broadcom has effectively built the most formidable toll road in the entire artificial intelligence ecosystem. While everyone is obsessed with who builds the GPU, Broadcom has quietly cornered the market on how those GPUs talk to each other. The reality is that Broadcom is no longer just a hardware company. It has morphed into a hybrid software infrastructure monopoly that effectively taxes the entire internet. The explosive 5.92% move we are seeing today is the market waking up to the fact that Broadcom's custom silicon business, specifically the chips they design for hyperscalers like Google and Meta, is scaling faster than almost any other segment in the semiconductor world. You aren't just buying a chip stock. You are buying the landlord of the AI data center. Let's investigate what is driving this specific intraday price action. The volume today is anomalous, significantly higher than the 10-day average, which tells us this isn't just retail traders on Robinhood chasing a green candle, this is institutional accumulation. When you see a stock of this market cap move nearly 6% in a single session without a specific company-issued press release, it usually signals a sector rotation, where funds are reallocating capital from overextended software names into high-cash-flow infrastructure names. Broadcom sits at the perfect intersection of both. It is likely that algorithms at major desks are reacting to positive read-throughs from peer earnings, specifically the recent blowout numbers from Nvidia, which confirmed that AI spending is not slowing down but accelerating. However, unlike Nvidia stock, which can be incredibly volatile, Broadcom offers a level of earnings visibility that creates a floor for the stock price. If you look at the intraday chart, notice how the price action reacted around the 365 level earlier in the session. That was a critical resistance point from previous weeks. The fact that we blew past it and held above it suggests that $365 has now flipped into support. Traders using interactive brokers platforms are likely seeing heavy call buying on the derivative side, which creates a gamma squeeze effect, forcing market makers to buy the underlying stock to hedge their positions, further driving up the price. This is a self-reinforcing loop that we often see in Tesla stock during its manic phases, but seeing it in a mega cap like Broadcom indicates deep conviction from the buyer side. Let's shift gears to the why behind this structural repricing. To understand Broadcom, you have to understand the master plan of its CEO, Hock Tan. For years, the critique was that Broadcom was just a financial engineering shop. They would buy companies, slash costs, and raise prices. Critics said this wasn't sustainable innovation. But if you look at the integration of VMware, which is currently being digested, the numbers are proving the critics wrong. Reports indicate that VMware's quarterly costs have already been slashed from $2.4 billion down to $1.2 billion. That is not just efficiency, that is a complete restructuring of the cost base. At the same time, they are forcing a transition to subscription models. This is the Adobe moment for data center software. By locking enterprise customers into the VMware Cloud Foundation, VCF, Broadcom is ensuring that its software revenue becomes recurring, predictable, and extremely high margin. This matters because it changes the valuation multiple. Hardware stocks typically trade at lower price-to-earnings ratios than software stocks. As Broadcom shifts its revenue mix to be 40% or 50% software, the market has to re-rate the stock higher. That is what you are seeing today. You are watching a hardware multiple expanding into a software multiple in real time. This is why investment help sites and investing sites are scrambling to update their price targets. The old models don't work when the business composition changes this rapidly. Furthermore, we need to talk about the custom XPU business. This is the most misunderstood part of the Broadcom thesis. While Nvidia stock dominates the merchant market, selling standard chips to everyone, Broadcom dominates the custom market. When Google wants to build its TPU for AI, they don't go to Nvidia, they partner with Broadcom. When Meta wants to build its own silicon to run its recommendation algorithms, they knock on Broadcom's door. This business is booming. Recent data suggests that AI revenue for Broadcom has grown over 200% year over year. That is hypergrowth concealed within a value stock wrapper. Let's pause for a second. I want to hear from you. Comment below how many shares of Broadcom you currently hold, or if you are waiting for a pullback to enter. It is always fascinating to see where the retail sentiment is versus the institutional flow. Now, let's discuss the broader market context. We are currently in an environment where interest rates are a major topic of conversation. In late 2025, the macro landscape has shifted. If rates are stabilizing or trending down, high dividend growth stocks like Broadcom become even more attractive. Broadcom has a history of increasing its dividend by double digits annually. For investors using Schwab Intelligent Portfolios or managing a Fidelity Wealth Management account, this dividend growth is the killer app. It provides a hedge against inflation while you wait for capital appreciation. Unlike Apple stock, which pays a very small yield, Broadcom pays a yield that actually matters to income investors, yet it grows that payout like a tech startup. Comparing Broadcom to its peers is instructive. If you look at SoFi stocks or the trending lists on SoFi Invest, you will often see semiconductor names dominating the conversation. But compare the volatility. AMD and Micron can swing 10 or 15% on a whisper of demand weakness. Broadcom, because of its massive software moat, tends to be more resilient. It's the adult in the room. Today's 5.92% move is actually quite large for Broadcom standards, which signifies a breakout event. It implies that the market was mispricing the risk of the VMware integration. The fear was that customers would revolt against price hikes. The reality, confirmed by recent channel checks, is that VMware is so deeply embedded in the enterprise stack that customers have no choice but to pay. It is the ultimate form of pricing power. Let's look deeper at the technicals on the daily time frame. The stock has been consolidating in a range for months, building what technicians call a base. Today's move pushes it right up against all-time highs. If we close near the high of the day, which is currently $375.67, it sets the stage for a blue sky breakout. In technical analysis terms, a blue sky breakout means there is no overhead resistance, no bag holders from 2021 looking to sell at break-even. Every single person who holds the stock is in profit. This creates a psychological dynamic where sellers disappear, and the price has to drift higher to find liquidity. For those of you engaged in self-investing or managing an individual brokerage account, this is the setup you dream of. It's the point of maximum opportunity with momentum at your back. However, we must also address the risks. No analysis is honest without looking at the downside. The primary risk for Broadcom remains regulatory and debt-related. The VMware acquisition added billions in debt to the balance sheet. While Broadcom is a cash flow machine, generating tens of billions of free cash flow annually, servicing that debt in a higher than longer interest rate environment is expensive. Additionally, the aggressive pricing tactics with VMware customers could, in theory, open the door for competitors like Nutanix to steal market share over the next 3 to 5 years. But in the short term, the next 12 months, switching costs are too high. Enterprises are stuck, and that's good for Broadcom shareholders. Let's analyze the actual hardware components. The Broadcom 10 Trent US FBAR chip is a semiconductor marvel. It is designed to filter very precise frequencies in mobile devices. If you open up an iPhone, you will find dozens of these tiny chips ensuring clear calls and fast data.